Hey, everybody. Sorry, we're about to get started here. If we could take a seat, we'll get started in just a second. Awesome. This is an awesome turnout. So thank you, everyone, for coming. We're excited you're here. Okay, awesome. My name is Hannah, and I am with Kiln, and we are very excited to have Mercado Partners and Pelion here for this event. And we're grateful for all of you for coming. So thanks for making the trek out here. I just want to tell you really quickly about Kiln. Is this anyone's first time here? We have a couple. Great. Okay, cool. Well, Kiln is a co-working space, but we're also a lifestyle brand. So we have memberships that range from one-person teams all the way up to 50-person teams if you need a space for your team to work. We have our club memberships that starts at about $245 per month, which is pretty doable, and then all the way up to 40-person teams. We also do events regularly. This is an example of one for our members. So you get access to that and this really cool community within Kiln. We have these day passes here that I'm holding up. This is one free day pass. So if you ever want to come try out Kiln for you or for your team, you just show us at the front desk of any Kiln location and you can work there for free for the day. My team is also on site. We're just up at the front desk here. If anyone wants a tour of the space or a little more information, feel free to come let us know and we can help you out with that. I'm going to turn the time over to Ben now for this event. But we're glad you're here. Thanks for coming.
Thanks, Hannah. All right. Everybody hear me? Think we're good? Hopefully you enjoy the tacos. I got a panel today. We want to thank our co-sponsors, Pelion, for putting this event together. We really wanted to showcase what Utah's about. Wanted to make sure that we brought the best companies in Utah together and brought some investors and, get some insights from each other. Hopefully we can get network with each other and understand, how can we make Utah even better from what it is today. So let's get the panel here and we'll make some intros. Take your seats. Yeah. Don't forget to turn on your, just flip it. Yeah, as long as you, there we go.
It's just this little thing right here.
All right.
That's right here.
Definitely technology investors. Yeah.
There we go. All right.
Okay, well, great. Thank you. Thanks for coming. I know some of you, both of you flew from out of state just for this event, so appreciate it. Maybe we can start with some intros and kind of introduce yourself. Ann, you want to go first?
Sure. My name is Ann Akichika, and I actually am based in Salt Lake City. Work with Wasatch Global Investors. We are a firm that was founded in Salt Lake City, and we're privately held, employee-owned. We are probably a top 5 global investor in small cap, and within the U.S., I would say we're probably top 1 or 2 or 3. We only do small cap. We manage about $20 billion and have 19 different funds. Of those, I would say, 60% of our assets are based here, are focused on U.S. companies. So we're very, I would say also we're private equity approach to public market investing. We buy companies, we don't buy stocks. We really like to get to know the company, your strategy, track management teams, really understand what's going to drive your growth, like to buy and hold and see stocks compound over 5, 10, 15 years. So a little bit of a different approach to public market investing. There's a lot of ways to make money, but this is the way we kind of focus on. So thank you very much for having us today.
Thank you for coming.
Awesome. Hey, everyone. Great to be here. Anthony Hardy. I'm with Franklin Templeton. As Ben said, flown from the Bay Area, but love spend a ton of time out here. Got family out here. Went to undergrad just down the road of Provo. So love to see the development here. Always excited to come back to Utah. For those who don't know Franklin, it's one of the largest global asset managers. It's about $1.3 trillion in total. The group that I'm a part of in the Bay Area, we manage a little over $100 billion. It's really our U.S. growth portfolio. So again, similar to Ann's strategy, like we're trying to find companies that we can own for 5, 10, 20, 30 plus years in the public markets. I wear 2 hats at Franklin. So one is I cover a couple sectors for us. I cover fintech and HR tech for our mutual funds. And then over the past 6, 7 years, I've been helping to build out our venture platform. So really excited about what we're doing there. We'll do late stage deals out of our mutual funds. So think, companies 12 to 24 months away from an IPO. Those will go in our mutual funds. And then, companies that are, maybe more 3 to 5 or 3 to 7 years away from IPO. We've got 3 sector funds. So one focus on enterprise tech, one focus on industrial tech, and then one focus on consumer tech. So trying to leverage the expertise we've built up over decades in our group to get to know, again, companies that we think, would want to own for decades in the public markets as early as we can, where it makes sense. So quick background on myself and my firm.
Awesome. Mike?
Thanks for having us. So I'm Mike Zappert. I work at TPG. TPG stands for Texas Pacific Group. It's based in San Francisco. It's a $135 billion asset manager. We recently went public in the last year, so we could talk a little bit about the IPO process and how fun that is. I lead our investing efforts focused on growth equity and growth buyouts. We have about $10 billion pool of capital that goes at that opportunity across a bunch of different sort of thematic areas that we think are really interesting. And where we help out is companies that have very good product market fit. They're growing nicely, but they want to have help to get from here to IPO or beyond, assuming the IPO market will come back one day, which we'll talk about. And we help across all aspects of being prepared for that and having a really successful offering over time.
Great. Well, you can all tell here that these guys manage and girls manage billions of dollars, not just pennies. So I'm really excited to hear your perspective on it. Well, let's maybe start by painting the picture. In 2021, companies were trading at 100 times ARR, right? And people were like, maybe that's even a discount. Today, I think the folks at Meritech put a report yesterday. Talked about they tracked the 100 best pure software companies. 20% of that 100 best were trading at 10x ARR, so almost like a 10x decrease from where it was in 2021. Everybody here, manage a company, owns a company, are thinking valuations are lower. What does that mean to you guys as investors? What does it mean to your investment pace? How does that change maybe your behavior, your mentality? And what would you say to a CEO, a CFO today that is, whether it's asking 2021 prices or realizing like, hey man, I'm not getting as much bang for my dollar anymore?
Sure, well, I'll go first. Having valuations correct is a good thing for us because we always want to put capital to work in a place where we're going to get return for our investors. And obviously the market was pretty buoyant the last few years. But I think what I would focus on if I were a CEO, and what we really focus on when we come to diligence you, is really your business and where it is in terms of, do you know your business model? Do you know what's special about you, what's differentiated, what's going to make you a strong company that's going to compound year after year after year? So know your business model and then have the people and systems in place to support that. So we're very focused on, you're going to have a banker panel later and they can talk more about the markets, but we're very focused on the business. So in some ways it takes the heat off of you that you don't have to worry about everything that's going on in the market because you can really focus on your business and building a really strong company. So we really want to see companies that are profitable now. We've always been focused on that, but when markets go up, we tend to lose focus about that, and there's a FOMO that happens, and people start chasing deals, but that's all off the table right now. So I think it's a healthy environment if you're well capitalized and you have a good plan for how you allocate your capital and how you're going to build your business and get to hopefully get to that next fundraising round with a really healthy business.
Yeah, no, definitely agree with that. Maybe just allow me to get nerdy for like 1 minute. I mean, one of the things I love to do with our late stage portfolio companies who, seeing their peers' as valuations in the public markets come down, like what's going on? Our fundamentals are actually holding up pretty well. Business is, still doing well, or we're close to plan. I'll literally show them the models, like, guys, like, look, in a year or two when you go public, we're going to be sitting across the table. You're going to be pitching me and other investors. There's public investors come in a ton of different flavors. Those who have a more long-term orientation, like Wasatch, like Franklin. Their analysts are going to sit down. They're going to build their discounted cash flow model. And I showed them, I was like, look, capital has basically been free because of the Fed, and fundamentals again haven't changed that much. But I literally change the discount rate assumption. And if all of your profitability is kind of like back end loaded 5+ years out, it's I take it up like, here, let's do 3 to 4%, 4 to 5%, and then you just see their eyes just start to bug when they see how much that impacts the valuation. So that's the unfortunate part, right? I think everyone, we're trying to find the best businesses. We're trying to help these companies build strong fundamentals. There are outside factors, macro factors that we don't control, but that does explain a lot of what's happening in the public markets. And to Dan's point, it probably is healthy, right? I think we can all agree there was some exuberance in the market. So I think just understanding that it's not your business. It's hey, that's just the reality of how investors that have to look across, have a wide range of ways they can invest their money, this is what they have to think about. That's just the reality of it. And then what's, with second and point, I mean, the second piece of advice I give folks is like, look, especially as you think about this path of profitability, like have a super, super tight grasp of your unit economics and be able to communicate that. I can't tell you the amount of like companies that were going IPO that couldn't really, walk me through in a convincing way their unit economics and the path to profitability. So, I kind of put people in two camps. It's easy to tell those who like kind of run their business and unit economics like are an output of the decisions they make versus those that really know their unit economics and use that to drive their investment decisions. And it's just as a public investor in an uncertain market, definitely much more willing to back that latter column.
Yeah, and I think the other thing is we've just gone through a period of time that's never happened before in human history as it relates to the amount of capital that was raised. The amount of capital is both raised on the private side, but also invested into companies. And so if you look at the stats, the peak watermark before this period of time was $100 billion that was deployed into venture-backed companies in '99. We thought that was like the biggest ever. In 2019, 2020, we got to $100 billion again. In 2021 and 2022, we hit about 300 billion of capital invested over a period of time. And there's a 0% chance that was all invested efficiently and into great companies that are doing really well with great unit economics. And so I think the thing that will really ripple through the system is effectively a stronger focus on fundamentals in terms of good unit economics, quality growth, making sure that you're not burning cash for the sake of burning cash, but burning it for the reasons that drive economic value over time for your customers. And that means lifetime value. It means having customers that stay over time. It's all the things that kind of go into making a great business. The big change from this year to, say, 2 years ago is capital is just much, much more expensive. And so if you have to raise it, it's coming at much, much lower multiples. And so as a result, you have to have a lot of discipline in terms of where you're spending it on, what are you spending it on, and what is it driving in terms of outcomes for you and for your customers.
Yeah, so it's definitely tough right now. And you guys talked about focusing on your business, focusing on the fundamentals. So I'd love to just, there's a lot of CEOs and CFOs here doing that, focusing on their business, making sure that that's growing. But let's pretend, they know their business in and out, right? They can walk you through the unit economics, they can do all this, but their business just isn't growing as much anymore. What would you advise them?
I can start. I mean, I think we're seeing it across the public markets, which is you look at and you all spend a lot more time in the publics than we do, but across the space in Q3 and Q4 this past year, everyone started to both guide down in terms of what they expected, but also started to miss earnings in a meaningful way, earnings both revenue and profit as well. And so all public companies, which are essentially the superstars, hopefully most of them are the superstars of our industry, those companies are seeing headwinds. Those companies are seeing less performance. And so if you think of that from the perspective of how that then translates the layer down to privates, the overall expectation is lower growth for this year. So I think any investor that you're going to meet with is going to be expecting lower growth, but they're also going to be expecting less burn and importantly, less burn. And I would say it's not a dogmatic, like, let's not burn for just the sake of saying everyone's not burning, so therefore you shouldn't burn. It's actually because my original point, capital is more expensive. It's harder to raise. Every dollar you're raising is much more expensive than it was last year. And so if you're going to burn, make sure you're doing it for good reasons. And so I would expect that most companies that in the past were thinking of it as, say, I need to be growing 30 to 50% or 50 to 100%, they're going to notch it down an entire rung into a much lower level in order to grow reasonably well, but burn less. I think that's the flavor of what we're seeing across our current portfolio. And then when we're talking to interesting companies in the market, that's definitely what we're seeing with them as well.
Mm-hmm. And you and Carrie and I were talking about the best companies out there today. Valuations have come down. We started about that, the difference between 21 and 22. How are you thinking about the best companies out there? Are valuations still high for them, or is there low? How do you think about it in the public markets? Maybe we'll love to hear Anthony's take on that as well.
Well, they've all come down, right? And again, we are so less focused on valuation at this point in time versus the market versus thinking about what could this company be. And we're not looking at fiscal year, forward year 1 or forward year 2. We're looking at 5 years out. So for us, the best companies are going to have a defensible strategy, have some sort of competitive moat, hopefully have pricing power, have a strong business model. And I would also layer on one of the things we really look at is culture, because culture is not a here now, gone tomorrow. It's something that is so important, particularly for a rapidly growing company. and we have a very strong culture statement, how we live it daily in our website. It happens. It happens. So we look at culture, we diligence management team. So again, it's putting together the whole plan, and I'm backing away from the valuation question because we're just not that sensitive to it. And if we do see a deal, I do think we're not, the IPO window is closed, but there are companies we'll invest in. But usually these are companies that have, management has a track record. We've followed them for a while. We understand their business. They understand their business. And it is reasonably priced. And we're going to look at the comps in the market. And unfortunately, the market's all come down. So we'll look at your comparable companies and probably apply a slight IPO discount to it. So.
Anthony?
Yeah, maybe just add a couple thoughts on my end, kind of, straddling both the public and private worlds. Like obviously one of the obvious differences, right? You have like daily visibility into like price movements on the public side. Typically the best, highest quality companies, they're only raising money, every, 12, 18, 24 months, right? So there's only a couple points in time. Naturally, right, if you're the founder, like, you're trying to optimize the best time to do that. So, kind of what we've seen in our conversations, like look, transparently, within the verticals I cover, fintech, HR tech, there's probably 5,000 plus companies in the space, right? There's probably, 50 to maybe 75 that like I really, kind of care about that I think are going to come up and be transformational companies. These top quality assets, right? I think the struggle has been like they're so well capitalized from what happened in 2021. They haven't needed to raise capital in 22. So there still is that, like we maintain very close relationships with them, kind of, waiting for, that moment where they said, hey, we need to go out and raise capital. But, I think it's TBD how those conversations are going to end up going. Are they open to, having a reasonable mark as they think about going public, or do they want to, absolutely maintain the last? So I think the jury's still out. I think we'll learn a lot more in 2023 as these companies have, kind of burned down what they raised in 21, even though they're, again, continue to be phenomenal companies.
Yeah, and I think just to layer onto that, I think there's a couple interesting things happening. One is, to your point, just on 2021, there's something like 1,400 unicorns, and 90% of them raised during that time frame. So basically, every single unicorn that's out there, whether it's a deserved unicorn or not, is well capitalized. And then it's a question of like, how long did they burn down that capital until they're ready to raise again? I think the other is, from the deals that we're seeing cross, of which there's not a huge number of them, but we've actually been active in kind of later stage growth equity deals and still getting stuff done in this current market. It's still happening at the comps, or maybe even a slight premium for some of the best quality companies, but it is for really high quality companies. The quality bar is just really high for folks to be investing in the current market. And so if you built a really high quality business, I think you can get a deal done in this current environment. And it's not like a terrible deal, but it's not going to be as good of a deal as it was last year or the year before, just based on what we're seeing.
Can we put some metrics behind high quality deals? Like what does that mean? What does a company need to be growing at? Does it need to be profitable? What do you guys characterize as like in the best of the best high quality?
I think we have different answers depending on the. I can start for us. We focus a lot on unit economics, and so we're looking at gross retention, net retention, magic number for sales efficiency. We're looking at things like the overall sort of burn ratio of the business in terms of how much is it burning relative to growth. So things like Rule of 40 matter quite a bit. So we look at a lot of those like kind of typical SaaS metrics to get a view of like, okay, if this company is it burning in a quality way? And with our capital, will we be able to fund this business to a point where it can go public without any other help or folks around the table? And if we can see that, even in the current environment where burn is very much, especially in the public markets, it's very much out of favor. The R squared on burn is like incredibly negative in terms of which companies are valued highly versus not. Even that kind of environment, we're essentially making a bet that with our investment in 3 to 5 years, the markets will resume some sort of normal service, at which point we can be investing.
Yeah, the other dynamic, just to kind of tie it into metrics, right, because it kind of depends on the industry, right, is like, so let's say you raise in 2021 at like, 50 or 60 times revenue. I mean, a lot of these super high quality companies are still growing, 150% plus while still improving burn. So you kind of do the math. It's like, all right, like maybe by the time they need to raise, it's like it's not unreasonable, right? The multiple goes from like 60 to 30 to 50, to 15 if they keep on compounding the top line. So I think that's like the bull case scenario for some of these higher quality companies that are still able to grow 100% plus while being able to show great retention and unit economics. They can grow into the valuation and like maybe they kind of escape the the down round. But if you're growing lower than that and not making progress, like you're probably going to have to, that's probably going to get you when people are thinking about the multiple for your next.
Yeah, it's hard to talk about numbers
Yep.
because it's like by sector, it's by situation, but we look at all the same metrics, whatever it matters for that particular sector. And we're not going to say you have to grow at 30% because there's some very interesting companies that are growing double digits, or low double digits, but their profitability is compounding year after year after year. So again, if you can show some ability to continue to either scale or you have pricing power or some of those things that are going to help us get to our numbers where there's a double and we believe business model and all the different elements of what makes a very sustainable growth company are there. That we're flexible on that.
That's awesome. The Journal reported this morning that Stripe is looking at potentially going public in a year. All right, and this might be if that does happen, I think that would open the IPO window again. There's some companies here that are maybe thinking about going public. What would you suggest they do today? You talked about, and maybe we can start with you. You talked about culture being one of the things that you guys do diligence. Mm-hmm. When I was at the state of Utah's public pension plan and we invested in managers, that's what we mostly focus on. And it's hard to gauge the culture in a 1-hour meeting, right? And especially when they're selling their business to you and you're trying to understand what they're doing. How can the folks here show you the culture of their business to you guys so that you guys get comfortable in investing in them? What can they do today so in a year, 2 years from now when they go public, you understand their business better?
Sure. Well, I mean, it comes from within, and it's no secret if you go public, we're going to diligence the management team. We're going to do our own diligence. We're not just going to rely on the bankers or what's in the public document. We have our ways of networking and looking on Glassdoor and finding other people, former employees who've worked at the companies. We do that kind of diligence. We don't do just the 1-hour diligence. So it really has to start from within, and that's I think what makes a lot of we live in a time where employees really want to be engaged and believe in what they do. And we also have ESG standards that we look at, and that ESG is environmental social governance. And governance is very focused on culture. So and I think you'd want it for your own business. You want your employees to be excited every day when they come into work, and you're going to get the best out of them. So it's a squishy answer, but that's how, and you can see it in sort of the press, and you hear from former employees or current employees. The internet's a powerful thing. There's a lot of information out there now, so can't hide from it.
I think the other thing I would add is the nice thing about kind of emerging from COVID and being back in the office, and most companies in most areas being fully back in the office, is the benefit of being able to come to the office, meet the team, spend time with the team, the osmosis that you get in terms of learning of what things are like. Nothing's going to be perfect. You're never going to get a 100% accurate view of things. But I think directionally you get a much better understanding by spending time in person, which was something we just couldn't do. There's like a 2-year period we just couldn't do it.
Mm-hmm.
Yeah, I was trying to think I agree with everything. Maybe just to like peel back the onion, right? Like I love telling our late stage companies, like, hey, this is what it looks like on the other side of the table. Like, look, at the height of 2021, when there was like an IPO, like there was literally I'd have one day to kind of like go through a story. I'd have a 1-hour meeting, and you have to like make a recommendation. All the SPACs. It was like every day there was like a new company. It was just impossible to do that diligence, right? So I'm looking forward to the day where like I can actually spend more time getting to know the companies. And then just the other thing to like think about. You mentioned Stripe, right? Like look, someone like Stripe, the market cap's going to be whatever it is, $50+ billion. People are the challenge with the explosion of capital markets. We saw in our portfolios, like, look, the average portfolio manager in our fund has about 100 positions, right? Most of them are large companies. When you IPO, typically someone like Franklin will get maybe like 5 to 10 basis points, right? So it's like a small position. So the more time you can spend ahead of the IPO getting to know the type of investors, if I were in your seat, like I would want to have, like that's going to behoove you, like as you go through this IPO process. It's really hard, meeting someone in an hour to be like, hey, yeah, let's put $100 million, to work, and even then there's probably liquidity problems. So But if you're reaching out to folks, and a lot of the banks put on great conferences, like definitely like get your name out there. And I would talk to like multiple types of investors, right? Like you've got two very kind of long-term, long-only oriented, big participants obviously in the market are hedge funds, kind of fast. Like I would love to like pitch your business to them, kind of like see the questions they ask, just so public markets better. I think that's one of the things catching up with people who have gone through the IPO process. There's just a huge spectrum of different people's focus on the investor side, and the more conversations you can have before going through the IPO process, the better.
I add one quick add, which is just the other thing that's nice about this time frame is basically people are inherently less busy on the investment side. So there's more time to be scouting, more prospecting, more spending time with new relationships as opposed to existing ones. And so as a result, going to these kinds of conferences, presenting at investor events, meeting with investors who could be eventually a potential investor in your IPO or in your company, like those are really valuable things to do. And right now, the opportunity cost to do that is actually lower because those groups are not, dealing with a pitch a day or IPO a day kind of situation.
Mike, you mentioned TPG just went public. Congrats. What would some here might be thinking about doing such a thing? What's the hardest thing? What should they be doing today? Is there a person they need to hire? Is there a thing they need to do to really prepare for that process? And and look, that's what you do every day. I'd love to hear your take on some of that as well.
Yeah, I can give two answers to that. I think one is just a company readiness answer, and the other is like the mechanics of the IPO. I'll do the mechanics of the IPO quickly, which is I wasn't super involved in that aspect of it. But what I would say is it's a lot of work, it's a lot of prep. You've got to hire specific functional folks like head of IRR, compliance, legal, other areas that are like you either have them or you don't for going public, and if you don't, you can't go public. So those are kind of like threshold things that you have to do once you know you're going public. I think as it relates to company readiness, I think that's like an area that we as investors spend a ton of time in. And I think it's a really important area to be focused on is, as you're starting to get towards 100 million of ARR, as you have nice metrics, as the company is growing nicely, you need to start thinking about ultimately, like, where do you want to take the business? Do you want it to be private in perpetuity? There's not that many that do that. Most usually go public or wind up, being acquired by a strategic. So kind of where do you want to be when the company grows up? And I've always had a philosophy of, for our companies, if you prepare to go public, which is probably the hardest thing to do as a company in terms of the rigor, in terms of the financial markets and what they look for, what they want to see, the types of metrics, all the kind of accountability you have to be a successful public company. If you can do that well, then the other parts of the business are much, much easier in terms of strategic exits or private equity exits or things like that. And so if you can navigate all the sort of muscle build and muscle memory you need to build to do that correctly, good things will happen and you'll have plenty of different options. You won't have to worry about when you go public or how, because you're going to be ready either way.
Anything else you would add, then?
Yeah, well, I think you were alluding to, because the last two companies I worked with went public while I was there, and I was a pre-IPO partner both times. So I've had the public thing happen to me as an employee, as well as taking a number of companies public as a banker and now being on the investing side. But there's a lot to, I think I would say, I agree with everything you said, but I think after you go public, the one thing you want to make sure is you set up your company such that it's not an event that runs the company. Both I was at Cambridge and Quest when it went public, and I was at Artisan Partners when it went public. And what was most important for me was that people weren't distracted with the stock price. They knew that that they're here to work at a company and what we're building long term, and the stock price is going to be the stock price. And so get them focused on the business fundamentals and how we have to change to institutionalize things and make them repeatable. And so year after year, you're making the company better. So more from an internal perspective.
Yeah. Anthony, anything you add from your side?
I think these guys cleaned up on that question.
Yeah.
So we can
Good.
move on.
Well, I can keep asking questions here, but I think it'd be more interesting to hear from some of the CEOs, CFOs to ask you guys some questions. So I'm going to open it up. Kate here has the microphone. If anybody has questions about growth, love to hear from you.
Question about like company culture. So, let's say a scenario, you've got a company that's been growing over the last 10 years, positive EBITDA. Tell me about why company culture matters to you so much, based on the fact that they've got a proven track record of growth and revenue, and clearly the culture is growth culture. So why does that then the management team. And often, you guys are stripping out management teams and putting your own in anyway. So why is that important?
Not sure I agree with that last part.
Sometimes. Yeah.
Augment.
Well, we actually love founder-led management
Yeah.
teams because you're passionate about what you do. You often have skin in the game, and your incentives are aligned, hopefully for a long term. Again, growing a business, not growing a stock. But culture matters a lot because as a manager myself, you employee retention and having people who are Wasatch has our average employee has been with us for 14 years. Our portfolio managers have been here for something like 17 or 18 years, and so having that consistency is really important. And then also just the day-to-day, we go in, we like to visit companies too, and we like to walk down to the bathroom and check out what's going on in the office and walk through the factories and see how engaged employees are, because that to us gives us confidence that, that this business is going to be here for many years to come.
Yeah, I think it's exactly right, which is a sustainability point. It's like, if you do things really, really well, build a first-class company that's doing really well, and have a great culture, it's going to be like unstoppable. Mm-hmm. But if you have a very tough culture, you have a lot of churn, the Glassdoor reviews don't look so hot, there's a lot of things that basically say that this company may be sort of redlining, and the prospective may not be good, rather than what we've seen historically.
And you've seen CEOs blow up companies too, right? Bad behavior. That can blow up a company overnight. So that's really important that we know what we're buying into. And so culture is, again, seems squishy, but it's so important.
Great. Thank you.
My question is different from my perspective. I'm not a finance person, but I look at it. But I've seen enough companies pitch me the same pitch, teams, friends. They make the same mistakes over and over again, and even when I tell them. But from your perspective, have you seen companies where you're like, gosh, I wish they asked me this question, because most founders don't, and so I could tell them without giving them unsolicited. And if you don't want to answer that, what is one thing that you keep seeing them do the same mistake over and over again, and you want to tell us again so that we really, it cements in our mind, so we don't come with you with that same mistake?
Yeah, maybe so. The first thing that came to mind, just because I've seen it discussed, a couple times, both with portfolio companies and companies we've looked at. I think one of the ways founders are trying to maybe get themselves out of this valuation hole where they raise, at a crazy valuation with very little revenues, is think like, oh, I can buy a business that transparently is probably a lower quality business, but it's got revenues, and they could show oh, I'm profitable, I have revenues, therefore my valuation. It's a public company now. You guys weren't a blend, right? No. Okay, good. But I remember it was it was a very good software asset, but they wanted to buy a title insurance business. My thinking was hey, they want to goose up the revenues, and it's come back to bite them in a big way in the public markets. Tried to talk one of our portfolio companies out of doing it. They did, they kind of went through with it, so hopefully it works out for them. We're looking at a deal right now where that's the strategy they're raising to fund this M&A. I was like, look, I love what you're doing, but I've just seen this movie a couple times, and you're not going to trick the public market investors. They're not, all ARR is not considered equal. So that was just the first thing that came to mind. I think don't make bad strategic decisions just because you're trying to solve for this valuation mismatch in the market.
I think the other one is, just in terms of picking your partner, picking the right investment partner for you. I've seen, and especially the last 2 years, we've seen the world's biggest rise of funding. And so valuations went up, all sorts of mistakes were made. But I think people focus entirely on price for a period of time because you could. And I think when you focus on price, what you get at the end of the day is not ideal in terms of a partnership. And so I think being very discerning about who you partner with from an investment perspective of doing, similar to the diligence you talked about, doing your own diligence, figuring out if they're good investors, that you want to work with them, are they good people, have they fulfilled for their companies that they work with, all that kind of stuff. I think being a discerning eye for the investors you work with is a really important thing, because it's not just price at the end of the day.
I would say the worst ones I see time and time again is overpromise, underdeliver. And I don't underestimate how hard you all work to make your companies work, and you have to be so strong and resilient and have a lot of courage, and you always want to put the best foot forward. But we prefer that people be a little bit more open and conservative, because when you do become public, your stock is going to perform well, even though we don't look at stocks, but look at businesses. It's going to perform well if you are conservative with your estimates and how you manage your business, and you over deliver. That's what drives the stock price up usually.
I appreciate that. Thank you.
Mike, I think this is mostly for you. Talk about to the CEOs and CFOs here how you value companies today on a growth basis versus a profitability or cash flow basis, and like you today and your firm today, talk about what you what's more important to you in the short term, and then medium term and long term.
Yeah, absolutely. So I think the long-term answer is pretty easy, which is basically, do we think this is a sustainable business that can grow nicely, compounding at 30% or better for the next 5 to 10 years in a space that we think is going to be interesting? So if you can do that, like, a lot of good things will happen out of that. I would say that the way we, and I referenced it earlier, the way we look at these types of businesses is we're not looking at it to invest 1 year and then like sell the next or the year after. We're looking at it usually on a 3 to 5+ year horizon. And as a result, like, if you look at the market where it is today, I would bet that at some point it's going to be better than it is today from a multiple perspective. If you look at all the data historically, we're in a period of time where it's so depressed that I think at some point it's going to snap back relative to kind of what we've seen in this kind of like 2-year kind of window of silliness. And so from our perspective, we want companies that can grow nicely. If they're going to be burning, we want to be burning with good unit economics to do that burn. And I think the only sort of change that we would say last year to this year is the magnitude of burden. We'd like it to be lower because the cost of capital out there, if somebody else needs to invest in the company, is just higher. And the paths to exit are more difficult today, but in the next 3 to 5 years, they're probably going to get better. And so our job is to basically back companies that we think it can survive 3 to 5 years, grow nicely, not need to raise additional capital beyond the capital we're providing. If you can do that, goodness follows, is the way I describe it.
Hi, I'm Carrie Barker with Cross Creek, and we used to be part of Wasatch. We also make late stage investments, primarily like Mike and Anthony. And one thing I've found with my public background, but being a private investor now, that we run into a lot of late stage private companies that their venture backers and the management teams want to go public, and they're good companies. They have good cultures, they have good unit economics, but we often find ourselves in the seat of telling them, you're a good company, you're not a good IPO. I'm just curious if Mike and Anthony also find themselves in that position. And I think to advise the group here, what is the profile of that company that is a good company, but you would recommend that they don't go public?
That's a good question,
Yes,
by the way.
very-
We're both
very
stumped.
Yeah, I mean, I would say, so just understand Franklin, right? There's probably like 7 different funds. A lot of them are like large cap, mid cap, small cap funds. So like, look, if you are trying to go public at like a $1 billion or $2 billion valuation, just know that like your natural audience is going to be limited, right? To kind of smaller cap focused funds. And then the other dynamic too is, you're probably floating maybe 100, 150 million. This happened to a lot of, companies in the fintech space that float maybe 100, $150 million. It just creates, liquidity problems. Like I said, it's like, man, I really love this company, but we own 5 basis points. We can't get it up. So, it's not to say like, hey, if you don't have a $5 billion plus valuation, don't go public, but just understand like those are going to be some of like the practical challenges for me sitting on the other side. It's like, look, this is a great business. I could see how you could be a multi-billion-dollar company, but until there's more float, until I can, it's big enough for me to pitch it to some of our larger pool of capitals, like, there's only so much we can do here. And then the other thing too is like, look, transparently, like there used to be like 15, 20 companies in fintech. Now there's like 50 to 60, right? So I still like, I don't want my portfolio managers to own 40 companies. So the really has focused like what is different about your business? If you don't have a clear answer to like, do you provide different exposure? Do you have, like if you're growing the same or worse with, same or worse, margin profile, we're probably just going to invest with like businesses that we've been tracking for years, right? So really having like that unique story, maybe it's a unique, trend or unique growth area to pique people's attention, especially given like, the challenges we've had with like liquidity and that type of stuff is how I would answer.
Yeah, and I think taking a company-specific lens, I think some of the things that we would look at would be if there's like a constrained TAM or some sort of issue where you just can't get to a big enough TAM to get public market investors excited, but you are a dominant company, and so therefore you can build a really interesting business for either strategics or PE sponsors to come and acquire. That's like one area where you can see like the road running out potentially for an IPO. I think that's one thing. We also look at how predictable business is. So companies with like recurring revenue SaaS, where it's just kind of like, hey, sell a contract, grow the contract, look at the net dollar retention. Those are great, but anything that has a reoccurring revenues, where it starts to be transaction based, that can be less predictable, and that sometimes can be a good business, but actually not a great public business, because guiding that kind of business can be pretty tough. Those would be the kind of ones I would look at. And then I think the third would be from a sort of product and competitive positioning perspective. If you're in a space where there's 2 or 3 public companies, they have dominant positions and pretty good products, you could build an interesting business in that space, but you may not build a business that's going to get public market investors excited, because they're going to look at that and say, that's probably going to be a number 3, number 4. But I should ask you guys because you're focused on that space, but that would be my assessment.
I could cheat with one follow-on questions. I'm curious when you think going public can help your business, just the fact that you're public can help your go-to-market, and when it can actually hurt you in terms of visibility for competitors or other ways that it can actually hurt you to be public.
Yeah, within fintech, I mean, there's some areas where, like, if you're selling technology to, banks, large insurers, like any sort of like B2B fintech, those customers care a lot about their balance sheet, having the transparency. Like I've seen that actually like be a huge, boost to growth and open up opportunities that weren't, available when they were public. In other areas, right, like in some of the the payments landscape where there's probably like 5 to 6 players in each submarket. Yeah, like I think some of these companies have felt like they've been disadvantaged because they have to disclose obviously a lot more than their private competitors. I think it depends on your end market. Do your customers seeing your balance sheet and your capitalization like help you sell more business, or does it give your competitors a big edge? It's kind of like the two things I've seen.
I think also acquisition currency. So having a currency to go buy things, especially in a market like this, if you were already public, having a currency to go buy in a depressed market's better than not. So I think that's definitely helpful. I'll on the negatives, I'll continue to go back, and it's a little to the points made about sort of watching the stock price. I do think it's one of those things where it's like when we went public, I kind of looked at it and said, okay, that's the price when we went public, and let's put it in a drawer, and we're going to forget about it for 10 years. And that's kind of how you have to think about this. Your employee team, your team will not think of it that way. They will look at it. It'll become a part of kind of the daily cadence. And so it's really important to kind of stress the mentality of like, hey, if we build a great company that's predictable, that's growing nicely, doing the right thing for customers, has a good reputation in the market, all that other stuff in terms of value and what this will be over time will take care of itself. The markets will go up or down, but we'll do fine. And I think having that kind of mentality is critical. And if you're not ready for that mentality, it's actually super detrimental to be public.
Well, and it's hard to manage your company to quarterly. There are some companies that it's very hard to manage your quarterly earnings. And so if you're not up for that, that makes it another big element of what you have to do day to day. When I was at Artisan, it's a mutual fund company. We very much, we understood it because we were investors, but we very much managed our investors to understand that we have a long-term perspective on things. So we're not going to do things to the business to manage the quarterly earnings. It was fine, but that's not every business is able to do that. So you have to kind of think about that as well.
Mike, Anthony, Ann, thank you so much.
Thank
This has
you.
been wonderful. Appreciate it.
Yep.
We're going to take a 5-minute break and then come back for the investment banking panel. Thank you.
Good job. Yeah, well done, guys. Well done. I'll say hi in the hall for you.
Thank you so much.
Hey guys, we're going to get started now. So I'll get started really quickly. I'll introduce myself as I am the least important person on the stage, and if people miss my introduction, they don't miss anything. My name is Ben Lambert. I am one of the partners at Pelion Venture Partners. We're an early stage venture capital firm here in Salt Lake. I think a bunch of you know us, and if you don't, that's our bad. We should know you. We've got a great panel of investment bankers today to talk to us about the market, to talk to us about IPOs and capital raising and things like that. We'll try and have enough time for questions at the end, but would love to start with about a minute from each of you, introductions on who you are, the firms that you work with, and kind of your specialty. Sam, why don't you go ahead and start?
Sounds great. Sam Moore, I'm Managing Director for B of A Securities. I actually live in Utah, grew up here. Started out my career at Robbie Stevens in San Francisco, pure tech M&A, and now I head the region for B of A for IPOs, M&A, and leverage finance when there is any.
Right, and you dressed very well
And
today,
I take
Sam.
myself very seriously.
Yes.
Yeah.
And by the way, this is the first time I've seen you in a suit.
So what
Sam.
happened?
Like, what's up with that?
Some of your kids may have sent this meme to you. It's an alpha.
An alpha move?
It's the alpha move they had this new vest of dads showing up at their kids' sporting events with their vests. And my wife makes fun of me because I have 7 vests in my closet and I wear them every day. And so I made her a promise that I could wear a suit every day this week. So I'm sticking to it. It's fun.
Okay.
And I'll be back.
So it's kind of
on
like
Monday.
it's kind of like a gag.
If you haven't seen the whatever it is, the TikTok on the alpha guys and their kids' sports, you should watch it. It's hilarious.
Hey, Latia, will you help cue it up? Okay. Go ahead.
Yeah, some need someone to show me where to find that. No. So I'm Greg Smith. I'm a managing director with FT Partners. FT Partners is a fintech-focused investment bank. All we do is focus on fintech. We sort of still call ourselves a boutique, but at this point we're about 250 people, very global. So we've kind of transcended the boutique, but since we just focus on one vertical, we're still a bit of a boutique. We basically almost always on the sell side doing capital raises or M&A, and we also do some IPO advisory work where we're not an underwriter, but we're kind of quarterbacking the entire IPO process. As far as my background, I really spent prior 20 years in a Wall Street capacity, the most in equity research. So I actually started covering fintech companies way back when fintech just started, kind of the online brokerage industry. So I've kind of had a pretty good seat seeing the development of fintech going all the way back, and just it was kind of fun. Just from the drive from the airport here, I passed 6 or 7 of our clients. So Utah, Salt Lake City, this area, Lehigh is really becoming a hotbed for fintech. And I flew in from Miami, so 80 degrees to 20 is a little bit of a shock.
Hey, greatest snow on earth versus the greatest beaches. So
There you go. But I'm based in the Bay Area.
My name is Terry Jackson. I lead our West Coast software efforts at JP Morgan. Sit in the investment bank. JP Morgan's a $400 billion market cap, large business, global business. I would say what most people don't know about JP Morgan is that over the last several years, we've really pushed our initiative to provide support to companies basically from the seed stage all the way to large public companies. And so we have teams of people here in Salt Lake that focus on commercial banking and treasury. I'm again part of the investment bank. Primarily work with companies that are private or public companies that are looking to do just about any suite of service that you would want an investment banker to provide, whether it be capital raising, whether it be M&A advisory. Ultimately we like to pride ourselves that we are able to kind of help provide just about every.
awesome. Thanks, guys. So 2021 was probably the busiest year of your guys' lives in terms of deals that were done and IPOs that were happening that happened. Daler, one of my partners, Daler and I were looking just the other day at all the IPOs that happened in 2022. He's like, there were 41 IPOs, right, Taylor? Something like that. And I'm like, yeah, but like 2 of them were tech IPOs, if that. So 2022 was probably like the slowest year of your lives. If you each of you wouldn't mind just kind of giving us your opinion of the state of the markets as it relates to really late stage capital raising, IPO, and for growth stage companies that you're seeing from a very broad macro perspective. How do you guys view the markets today? Go ahead. Yeah.
So at the beginning of 2022, JP Morgan had, I think, roughly 100 companies in tech that were mandated to take public. Obviously, most of those companies, all of them didn't go public. So a lot of them have gone through the process trying to figure out what's next. In certain instances, those companies were looking to go public to raise primary proceeds to fund growth. And many of them have looked at different alternatives around how to fund that type of growth. I think if you look over the past number of months, we've seen a number of very high-profile software companies go out and raise capital, varying from like structured debt, structured equity type deals to some doing down rounds. So there are some folks who've had to go out and raise capital, and they've done so. There are other folks who raised money in that 2020-21 timeframe, have plenty of air cover to keep growing as a private company, and they will continue to do so. So there's a number of companies we have that are looking for the IPO market to open. We actually have a company that we hope to launch an IPO for pretty soon, maybe as early as next week in the tech space.
Breaking news. Breaking news.
So-
US based?
Yeah.
Cool.
So that being said, I would say that the software IPO market that I cover, that's still probably more of a situation where we'll see those companies come out probably in the second half of this year. And we have to see a lot of things to kind of prove out that. I think first and foremost, we need to see a situation where the economic backdrop is strong. We'd like to see rate rises to decline. We'd also like to be in a position where companies are able to look at where the valuations are for public comps, and they can feel very comfortable with it. I could talk forever, so I'm going to stop and give people an opportunity to talk.
Yeah, I agree pretty much with what you say. I've got a little bit of a different purview, but just thinking back, it's obvious we had a bubble. Multiples have fallen in many cases 70, 80%. That's not really normal. So clearly we had a bubble, and we have to kind of work off that excess. As I think it's all about getting some sense of stabilization in the market, some sense of some visibility that the Fed's not going to hit us with a big surprise, that the economy's not going to completely fall apart. And I think we're starting to see some of that stability. The other thing that has to happen is just the company and management expectations versus the reality. There's been a big gap there. Anybody who's selling, in an IPO, whether it's a private equity firm that's an owner or founders or even employees, they're harking back to where valuations were a little bit. And so that gap needs to close. And I'd say literally within the past week or so, we're starting to see some management teams kind of cave, so to speak, and say, all right, we're willing to accept a much lower valuation, and that can get the machine going. And that's starting to happen too. So starting to feel like, the kind of the signposts you need to see or whatever for things to start moving again are starting to come in place. I'm not 100% confident. But then when it does, there's still so much money out there. Where else are you going to invest? Interest rates probably aren't going to stay at 4 or 5%. I'm extremely optimistic about sort of global capital markets investing over, any 2, 3, 5, 10-year time horizon.
Awesome.
So I think, Greg, just to piggyback on Greg's point, we too have seen finally management starting to do deals. Think D, C stage business taking a down round, and just let's call it like it is. This bubble popped a year ago, right? And we're now finally seeing that. That's probably a good sign. And then I think a lot of times we as bankers take some hits, and people say, geez, you bankers really push valuations too far on IPOs, and you guys caused this. And come on. Like,
You greedy investment bankers.
the Fed,
You and your
the
fees.
Fed created this, right? Like, they pushed, money's free, and so you got to go find a home. And, that's what happened, and it was out of control. And, there's a lot of some regulatory issues we can talk about it, and we'll get to SPACs, and obviously have some strong opinions. But, fundamentally, I think all of us would agree, we're extremely bullish on SaaS as the next blue chip. It has been the blue chip, right? SaaS has outperformed the NASDAQ by almost double, I think, in the last, whatever it is, 10 years. SaaS is up 200%, NASDAQ's up, 95, so double. So the alpha is in these really durable, sustainable, recurring revenue businesses. Every investor knows that. And we're starting to see it come back. The IPOs are going to start up here. We've all got ones that hopefully come out in late Q1. And, I've never been more positive because these businesses really have a reason to exist. Investors really want to be a part of it. And, we live through this bubble and it's painful, and people need to reprice their options because there's a lot of CFOs that are depressed that came onto a business thinking, they were at this price and now they're way underwater, and we got to work through that. And it's muddy and there's feelings, but we're staying positive.
So both you and Greg, Sam, talked, and I'd like both of you to maybe talk about it, how management teams and owners of these businesses have finally, to use the CNBC word, capitulated to kind of the market environment. I use the term they've found religion on these things. What has caused this tip over? Like, is it just they see the bank account dwindling and they desperately need cash, or is it just like, we want to keep growing? What are the factors?
From us, it is. It's that burning fuse. It's that, I'm talking mostly about somewhat later stage CD round companies that do need additional capital to grow. And it's that burning fuse. And finally saying, we need capital. The other thing I should have mentioned, there are a lot of deals have been done over the past year with structure. There's been all kinds of structure so you can avoid the quote down round, but you're guaranteeing an investor a 20% or even higher RRR.
Will you talk about what structure, what do you mean by structure?
There's some highly customized element of the security that they're investing in. So it's not just a standard one-time liquidation preference, preferred stock, converts to common. There could be sort of guaranteed returns. You get that return before any other investor in the cap table.
Said another way, 6 months ago, participating preferred became back in vogue. We hadn't seen it for 5-6 years. So basically, I'm getting 20% before you get a single dollar, no matter what price we agree to in terms of valuation.
Yeah.
So heads you win, tails I win, and that's not bad. I'm not saying that in a negative way. A lot of founders love it because if you were given a valuation of 300 million straight common, and that's the value that I offer you, and then Terry comes to you and offers you 500 million participating preferred, you're going to do the math. You're like, I'm going to hit my projections. I'm going to take that because it's a lot less dilutive. Yeah. Let's go.
If you're confident and you actually hit them, yes.
Then you've won.
But,
so there's value in it. I'm not downplaying it. There's a lot of value in structure because you can often get a lot higher valuation than a typical common deal. But that's what we've lived through, and now you're starting to see.
Well, it's that continuum. So there were a lot of deals done with structure and people sort of debating, should I do it, should I not? And now I think we're getting to the come to Jesus, religion, capitulation moment. If you need capital. I mean, that is the other thing, and I think everyone's kind of said this. These huge, massive rounds in 2001, even though companies are never going to see those valuations, they have that capital. In 2021, they have that capital. They've got it on the balance sheet, and so they're going to have a little bit of a curse, a little anchor on that valuation to deal with, but they got the capital. They're going to survive. They're going to live on. And so was it a good thing, bad thing? Probably a very good thing, even though they're going to have to deal with
it. Terry, help us think about how out of whack or in line do you think public multiples are on a forward-looking basis. So specifically, today, I think today the average SaaS multiple, and I'm saying SaaS because most companies in Utah are valuing themselves this way, are the median SaaS multiple is at like 4.5.
4.8.
Between 4.5 and 5x.
Depending on what index you use.
The top decile of companies in the SaaS public market are trading below 10x. I personally think neither of those things, those two numbers are as crazy, maybe not as crazy, but close to being as crazy as when the median SaaS multiple was 22. How do you think about the market today and how it's trading, and when do you think there's going to be a reversion back to the historical mean of 8 to 10 on the median and then 15 on the high end?
So a couple of things, and kind of stole my thunder there a little bit. If you go back through software for the last 10 years, the median multiple is about 6 to 7 times. We're obviously around 5, so we're below the median multiple. I think that we will see a mean reversion back to that. If you look at the top 5 or top 10 or top decile, those companies traded north of 10 times, forward revenue. And so if you're thinking about your business and you can benchmark relative to those high growth companies that are in that kind of top decile or top 5, top 10, that's probably the benchmark that you should be looking at. Now, obviously, if you're earlier stage and your growth even higher, those multiples might be higher than that. If it's a competitive process where people are really trying to get into your cap table. But as far as like the time frame of when I think things are going to come back, I think you're going to see them stabilize around that kind of long-term time frame. So what does that mean for all these companies that raise at 15, 20, 30, 100 times revenue over the last few years? I think what it means is you got to grow into your valuation or reevaluate kind of like how you're going to get to where you need to get to. The reality of it is, if you go back over the last several years, you're looking at an environment in the public market where you only saw maybe 10 to 20 software IPOs every year, right? In 2021, we saw 50 software IPOs. So 2021 is obviously an anomaly year, plus we had all the SPAC deals. So I think that's the other thing that a lot of companies need to figure out is, do they have a company that has all the check marks you need to be a public company? And, I kind of think of there being like 7 or 8 things that you need to be a public company, which I could talk about as well. But I think the time frame is people are going to be in a position where they're going to need to raise capital probably in the next 12 to 24 months. And they're going to probably have to do it at different valuations than they did their last round. And so they're going to have to think about structure. We've talked about, they're going to have to think about, do they want just a clean term sheet at a down round? And then when the IPO market opens up, you're going to see the first person probably take a significant discount. So JP Morgan led the first IPO during the global financial crisis in software. That was SolarWinds way back in the day. They've gone public again. We got taken private and gone public again. That was about a 1.5-year process before they actually went public. They went public in May of 2009. And in that deal, that was a business that had 20 to 25% margins. It was growing 20 to 30%. So it had a really good mix of growth and profitability. And they took a significant discount relative to probably what their fair value was. But they ultimately got their deal done. It went up, and that really kind of restarted tech and software IPOs post-global financial crisis. So the time is going to come. There are plenty of really, really good companies. And so that really comes down to a lot of the things I just mentioned.
Just one thing on the valuation. Looking at it more from an EBITDA perspective, we're seeing great companies trading back at 10 times EBITDA. I mean, that was the rule of thumb 10, 20 years ago, sort of for valuations, 10 times EBITDA. We're seeing a lot of that out there. And the other proof where we're starting to see the thawing, there's PE deals. We've seen some LBOs, we've seen a few strategic deals, certainly in fintech, and those are great signs. Looking at these valuations and thinking they're really low, and all of a sudden a strategic comes in or a PE firm comes in, even with pretty tough debt markets. So those are really good early signs. When I see that stuff, I'm starting to buy stuff myself when I'm seeing PE firms with longer time horizons taking advantage of the valuations out there. So we're seeing, certainly starting to see that.
No, I think that's great, and I think there's a follow up to that, and I'd love to hear from each of you. What are like the things that growth stage companies today should be doing to prepare themselves for a liquidity event, whether that's an IPO or an acquisition or strategic acquisition. Maybe you mentioned there's 7 things on the IPO side, Terry, but maybe 2 or 3 things from each of you on what should the CFOs and CEOs be doing in these companies to put themselves in the right position for when an acquisition or an IPO needs to happen.
Well, I think first of all, they need to have a good sense of what the visibility of their growth is going to look like. I mean, especially if you're going to go public, you're going to provide research analysts and investors with, call it 2 to 3 years of what your future business is going to look like, and you're going to do it potentially on a quarterly basis. And so you're going to be judged on those things. So probably preparing to go through that process and thinking about, can you estimate where you're going to be next year in the first quarter and how accurate you can do with that. I think being able to do that's a key part of it. The second thing I would say is really making sure you have a really strong go-to-market and have really good sales and marketing efficiency for your business. I mean, to be a business that is at 30 million of ARR growing very nicely and to become a $300 million ARR business, you're probably going to have very different, a sales force or sales and marketing organization as you become a $300 million ARR business. So thinking through all those different types of things are very important.
I can give a couple. I mean, there's a ton of things that I think we could do a whole panel on this. Obviously, the visibility and predictability in your business is key as a public company. You've got to have that. You've got to have a very clear growth story. You've got to be able to tell your growth story, have it be very, very clear. Here's the milestones. Here's what we're going to do. That's going to enable us to grow 20, 30%, for many years. I think you also have, even if you're not necessarily doing M&A, having an M&A strategy, having thought about it, having thought about companies you could potentially acquire. I just met with a company yesterday. They said, well, we want to do some M&A. And I said, well, can you send us your target list or whatever? And they literally didn't have anything. So they had no strategy. That was not a credible story to be telling. And then, there's obviously, the other big thing I think is just kind of always be ready. So even if you're not raising capital, have your data room, keep it updated as if you were about to raise capital. Have your management presentation updated so that any given moment, you could basically kind of go to market, somebody knocks on your door and wants to acquire you, you're completely ready. And I think the process of that forces a lot of discipline internally from just a readiness perspective. I'll keep it short.
This conversation's circular, and so I'm just making some notes. I think one of the reasons people haven't gone public yet in Q1 is to get to Terry's point about projection cadence and your ability to project. It's really hard to project in an environment where you're not sure where interest rates are going to be. You don't know if there's going to be a recession. Obviously, I think it's mathematically impossible for it to be the recession right now this year, and we can come back to that. But when you think of Twitter's interest rate at 14% right now, you think of where interest rates are for risk-free, that does have an impact on getting back to traditional software valuation multiples. And so are SaaS stocks undervalued right now? 100%, right? Do I want my mom in the S&P or in a cloud index? 100% in the cloud index. It's mathematically 30% below where it should be, even with where interest rates are. But still, interest rates are where they are. And so to really say we're going to get back, sure, if we're at 4.8 now and we should be at 6 or 6.5, that's probably right. But to get back to 8, we probably need interest rates to come down by 200 bips or something. So this is all circular. And the main thing is when you go, you want to be able to have at least projected a few quarters to make sure that you're on target and that you have a good feel for your business and all the unit economics and everything. The last panel I thought did an amazing job on. But then you want to have some economic visibility as well. And that probably, if we're all honest with ourselves, has held it back as well. Because if you're a CEO and you've got to put your name on those numbers, you want to hit them.
Yeah, and I think Ann said it, the under promise, over deliver is key. People are going to pull out the deck from a year ago, 2 years ago. It's one of the first things we do. Somebody comes to us potentially as a potential client. We're looking at what they said before, or prior decks. What are we going to have to deal with in the marketplace that they overpromised about? I mean, that's key. I mean, entrepreneurs get excited and the business is growing, but you gotta dial yourself back potentially. And it's all about building credibility. You want to be building credibility from day one with the VCs, PE firms, and eventually public investors. Credibility is key. Once you lose that, it's really difficult to get it back too.
I'm going to ask you specifically a question, Greg, about the fintech market. And then I want to ask about
favorite topic.
about SPACs. So FT Partners and Greg's partner Steve McLaughlin are the preeminent investment bankers.
Very average. Very average.
Just
Somewhere in between.
Yeah.
Somewhere in between.
In terms of fintech, right, you guys represent, you guys have or do represent probably like 5 or 6 of our companies. You probably don't know that, Greg. But, they represented Divvy when Divvy was acquired by
That was the
Bill.com,
drive down.
which sold for a phenomenal forward. Actually, I think it was looking back on it, they got a great deal. But anyway, fintech has disproportionately been like impacted negatively.
It's kind of been the poster child almost.
One of the upside of the exuberance, and then on the downside,
Yeah,
things
on sort of the downside.
Yeah. So talk about that market, and then I'm going to ask Terry and Sam about SPACs and are SPACs dead?
Fintech it became super popular. I've been doing fintech for 20 some odd years, and it all of a sudden became super popular, super synonymous with sort of high growth, and kind of took over from sort of the high growth, sexy technology companies. It became the thing. And, we saw a lot of high valuations, and I'm not exactly sure why it's become the poster child. I mean, everything we're seeing, the digitization trends, the need for tools, and what's happening in emerging markets. I mean, all the trends are just
when you hit it
amazing.
right, it sells. When you hit it right, it scales so fast.
Yeah, and so nothing really, there's no single horrible event. I mean, on crypto there is. Yeah. There's obviously a big black eye fraud, FTX. On fintech broadly, it's really just been sort of valuations coming down along with everything else. And some of the public companies, people look at PayPal. I think that's one of the problems I get frustrated with. People look at 2 or 3 public companies, and to them that's fintech. Whereas I'm looking across healthcare payments to, CFO suite to emerging markets, businesses in Africa generating $300 million in revenue. We just have a totally different lens. So I don't have a great answer for that, other than it was really popular, gained the poster child. Here we are, but things are great on the ground.
And will it come back?
Absolutely, absolutely. I mean, there are, talk about the unicorns, there's at least 100 and something fintech companies that at least were unicorns. There's probably 60, 70, 80 that have raised 500 million. Now, probably half of those are never coming back, but that means half of them are great companies. We're going to see some really good IPOs. I mean, the companies we're working on raising capital right now, still growing dramatically. I will say the excitement is disproportionately in emerging markets. I keep saying that, but we're seeing incredible business models emerging in Africa. Nobody would touch Africa 5 years ago. We've got companies with 100 million ARR, 40% EBITDA margins, growing wildly. We've got that in LATAM. We've got that in India and Southeast Asia, even Bangladesh, believe it or not. So,
Greg,
I'll wind myself down.
I'm chuckling. My partner Abdu, wave your hand in the back. He's Senegalese. He has a very strong fintech emerging markets.
I hope you saw our
thesis.
FinTech in Africa report we published 2 days ago.
Yeah.
200 pages of labor. So.
There you go. Sam and Terry, SPACs were the thing in 2021 for what I believe were companies that wanted to go public but couldn't go public. So they went public via SPAC. Maybe tell me if I'm wrong in that characterization. And how is it today?
I'll disagree. Look, SPAC's been around for a long time, since I was a kid, right? Since 99. And they can be efficient ways, and you can say they're dilutive, but there's ways to structure the dilution so that it vests over a period of time at certain stock prices. It can be just as efficient as an IPO and provide more capital for your growth strategy, et cetera, and bring in a partner. There is value in the SPAC market. The SEC has officially said, we hate these things, they're dead. They basically said, B of A, JP Morgan, you guys are solely responsible for the projections. And, if they get published, good luck, you will be sued. So the SEC shut it down. And I know there's a better way to say that. I think it's the only accurate way of saying it, frankly. There's some smaller investment banks that will put their name on it because their balance sheet isn't as exposed. And if B of A does a SPAC deal, we're a big flashing red sign that says, please sue us. So we just can't do it. And it's unfortunate. It's great that we're getting this out of the market. I think it's a good flush. But I'm kind of sad about it. Like there's a good reason for 20 SPACs a year to be in the market, finding some private companies where it makes sense to do a deal like that, and that may be an unconsensus opinion.
No, the one thing I'd say is that where a SPAC can add value when you have a really strong SPAC management team. You've got a group of experienced people, whatever they are, senior, whatever, entrepreneurs. When the SPAC sponsor team has significant experience in a sector or has taken companies public before, it's almost like another layer of management. It's a great group of advisors. So that's where I think a SPAC can still add a lot of value. You have a company that's a little bit rough around the edges, so it doesn't quite fit the normal IPO scenario, and you bring in that team that can really help them add significant value. That's where a SPAC makes sense to me. So I hope there's still sort of a role for that, for sure.
That doesn't mean 60% of those companies that went public via SPAC shouldn't have gone. They shouldn't have done those deals. I 100% agree with that. It got way too frothy. Sorry.
Yeah, and I'm talking about the minority of the SPAC deals that have been done. There were a lot of unusual SPAC sponsors and deals that you think, well, what's the fit here?
So I'll be candid. When I talked to software companies during the 2019 through 2021 timeframe, when there was a bunch of IPOs, and they were like, we want your view around SPAC alternatives, we would basically have a page that would show, these are the pros, these are the cons. And every time I would give that page, I would say, look, if you have a good, solid business, go public in a regular way. Might take a little bit longer potentially. I know some people will say you could actually do it faster via SPAC. In fact, I remember one specific pitch where I was talking to a software company, and they ultimately didn't agree with our view that you could to go public regular way IPO, and ultimately started going down the path of a SPAC deal. I got engaged to take another company public the next week, and that company went public 3 or 4 months before the other company was fully de-SPACed and trading on the NYSE. Now I realize that's just one data point. I think I struggle because to Sam's point, the regulatory environment has changed, so it's going to be harder to do SPACs. But I think again, there is an opportunity for SPAC money to be used. I personally think it's probably in other sectors. Personally, I would rather see more SPAC deals in industrials, energy, other areas, places where there's hard assets. Personally, that being said, I also think too that many of the companies that are evaluating a SPAC alternative can get many of the same benefits from just doing a private equity. I mean, you could get access to people that will be on your board via the private equity firm that are going to provide that expertise. They've probably done a number of deals in that space. And so you could go out and do a private equity deal and just not have to operate as a public company. I mean, that's the other thing is if you are a tweener company about going public, it's not going to be any easier being a public company. It might be potentially faster, but you're still going to have to go out there and operate as a public company. And as you grow into it, it's a little bit tougher. Now, there's a lot of companies that did SPAC deals that are much larger. Look, I mean, I'll give you 2 examples. 2 companies that did SPACs. We recently just sold both of them to private equity firms. One of them is actually one of them was to a strategic, one was a private equity firm, a business called Paya, which we just sold to Nuvei, which
Fintech.
it's a fintech business, but good example. And then the other one is Bill Trust, which is a quasi fintech, quasi software business, depending on who you talk to.
And so it's a fintech.
It's fintech, unequically. Fintech.
All right, well,
Okay. If there's questions, raise your hands. I think we got a microphone. As people raise their hands, you're not allowed to know. You're not allowed to predict companies that you know are trying to go public. But first one out of the gate, who do you think it will be to go public in 2023?
In Utah? Or, oh.
I'm not. I'm literally not going to comment on that.
say that.
Yeah.
Like,
Well, I mean, Stripe was in the news today. We heard it early. That was my go-to name, and it's not imminent from what they're saying, and we obviously have no involvement there. So, I mean, Stripe's one. It's the kind of company that could go public and kind of re-energize the market, so to speak, just given the size and scale of it, for sure.
And I'll say the first IPO in Utah will not be a software company. How about that?
Okay.
That's kind of non-consensus, right?
Yeah, that is.
A little bit.
Yeah. Okay.
I would just say, generally speaking, the company that goes public first in software land is probably going to have a decent mix of growth and profitability. I'll just leave it at that.
Yeah, I would be shocked if
Like
it
you're
was
not going to
burning.
It's not going to be burning a ton of cash.
Yeah.
It's going to have scale. It's probably going to be a name that a lot of people know. Frankly, that there's a lot of institutional investors around it, and it probably will be a smaller deal than it would have been in a normal environment, where most of the deal is going to go to probably the top 10 long-only investors who probably are already in the cap table. And that's kind of what I predict will happen. And then hopefully we'll get a couple of those out, and then people will be like, you know what, I do want to, invest in companies that are private that via public or taking them public, and then we'll have.
Yeah,
a
and
lot
if
more.
you're only selling 10%, the dilution of going now versus trying to wait till it's better, to me, it's sort of insane. You want to own, a small percentage of a massive thing, or you want to game it and try to get a little more ownership. I just think that's insane. You're better off getting out there, now's the right time and the business is ready for it, than trying to eke out an extra multiple point or two. That's always insane to me. If you're selling 100%, that's different. But if you're selling 10%, it's foolish, I think, to worry too much about it.
Questions? Anyone have questions? Because if not, I've got one more question. Yeah, Ben.
Greg, you mentioned the buyouts, the private equity investors coming in. What would you say a company that can potentially go IPO or be just acquired by a financial sponsor? What are the pros and cons in there? Thoma Bravo's being clearly very active, taking companies private. What would you guys think about the pros and cons of going IPO or just selling to a Thoma Bravo or whatever?
Yeah, I mean, once you're public and you have a board of directors and institutional owners, you lose control. You sort of lose control unless you've got super majority. So kind of becomes out of your control when you're a public company. Somebody comes along and you're always for sale, essentially. And somebody comes along and it makes an attractive offer. It's even if you're the CEO, it can be out of your hands. It just depends on the structure of the company. So you sort of lose control. If you're a private company today, going on the IPO journey lets you participate in the future growth. That's the other thing. You're sort of taking everything off the table too. Now, often management's re-incentivized, so it's hard to give you a simple answer. We always say every company has its own DNA, their own cap table, different management teams, different incentives, motivations. So it's a little hard to say. You just have to think about, sort of selling as an end game. An IPO isn't really an end game, but then you lose that control. You're always for sale. So just really depends on the situation.
Last question, we'll get you out on this one. There's companies in here, we've got portfolio companies in here, and that I know that, in the next 12 to 18 months, they're going to be thinking about this, right? They're on the pathway of doing some sort of liquidity, either IPO or try and go run a process. When should they start engaging with folks like you? And then also, what's the criteria that you would, if you were if you were the CEO of a company or CFO of a company, what would be the criteria as you evaluate and a banker to help you either raise capital, go public, or sell the business?
You want me to go?
I'll start first, and then Greg will go.
I love different answers.
I would say you should probably have a relationship if you're thinking about going 12 to 18 months now. That doesn't mean that that's your only relationship. Theoretically, you should be talking to multiple people to get different voices and get different perspectives. If you're going public, you absolutely should be talking. I mean, I would say usually it's 2 to 3 years of preparation before you go public, typically, in the sense that you want to do a lot of things under the hood, but also there's a lot of things that you want to touch. We had some folks on the panel that are long-only institutional investors. I mean, they probably want to talk to some of these companies before they actually invest in the IPO. They would love to talk to them 10 times, see them at conferences, talk to them, as part of like the testing the waters process of an IPO, and then also on the roadshow, and then another spectrum. So from that standpoint, you want to have somebody who you can call that you can trust. But as far as the criteria that you're looking for, you want to have somebody who has credibility, ideally somebody who's at a firm that has worked on a lot of deals in the space you're in, that has the characteristics that can basically provide good advisory experience. I think one of the great things about JP Morgan, to be candid, is because we are such a large firm, when people come talk to us, they know we're going to give them the straight answer, because at the end of the day, we're not just focusing on one area of investment banking services. And we're like, look, we want to be a partner with you long term. And so we want to help you out to make the right decision for you now. And if the answer is you're not going to do a transaction, that's great. You'll do a transaction down the road, but we want to make sure you're doing what's right for your business at that point in time.
Yeah, I'd pretty much agree with what you said. I mean, the funny thing with investment banking is you're typically paying on a success fee. So whether it takes 6 months, 9 months, or 2 years, you're pretty much paying the same fee. That's one of the things. So we always encourage to engage super early. I mean, we're very long-term focused. We're privately held. We're not trying to make any quarterly numbers. We're super long-term relationship oriented. So we love to get involved. We get involved 2 or 3 years sometimes before a transaction. So, I mean, it's similar to what you said, but I think that's the way you all should be engaging with bankers. It should be a real relationship. They should be providing good advice. You should be kind of testing the waters with them. You should be talking to others as well. But get involved early. I mean, the IPO, we've only kind of scratched the surface on all the things that have to be put in place in order to have a successful IPO. So if you're really thinking about an IPO, it's a multi-year journey for sure.
Also, I would also say too that, you want it to be a double-sided relationship. You don't want the investment banker just talking to you and not adding value. You want them to be able to demonstrate value to you. Look, I was with a couple of different companies who are evaluating going public over the next couple of years, and we were just having a conversation about customers. Like, who are your top customers? Who's on your target list? Is there somebody that we can introduce you to? Maybe there's a company that we cover, or somebody within JP Morgan has a relationship with. We have this technology innovation strategy team within JP Morgan who are like super, super deep experts in all these areas of software and technology, because JP Morgan spends billions of dollars on tech every year, and they're a great resource to go talk to and get perspectives around, what other people are doing and how they're thinking about things. So you ideally have somebody who's going to think about creating value for you, not in the actual sale process, but throughout your life cycle of your business.
Thank you guys so much. Really appreciate it. Flying in from San Francisco via Phoenix, Miami. I hope you're staying
via New York.
Via New York. I hope you're staying for some movies and skiing.
I got an Uber in a few minutes.
Okay. Well, thank you so much, guys. Really appreciate it.
Sure. Thank you. Nice job. Nice job. Took the words out of my mouth.